Hey everybody, Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, August 2nd, 2024. Hope you're having a great week and enjoying the beautiful summer weather. It is hot outside. A lot to talk about. Markets, we find ourselves here in the midst of a bit of a correction. Surprising to many, not surprising to us. We'll talk about that, where we think the markets can go from here, as well as some of the key economic data we saw this morning. We'll discuss that and the Fed decision as well. So first, let's start there. Fed meeting on Wednesday yielded no change in policy. Fed holding rates steady, noting progress on inflation, and likely setting the stage for a September rate cut. Initially, the markets really shrugged it off, traded higher on it, but as the week has continued to progress, and we fast forward to this morning, where the jobs report came in very light, 114,000 jobs, looking for 175. All of a sudden now you have created a fear in the market that perhaps now the Fed is behind the ball, behind the curve, if the job market is weakening, as this data suggests. So markets, when they want to correct, they will find a reason. Everybody wants to point to one particular thing. Sometimes it's just a market that's looking to pull back and use whatever is a current event as the reason to do so. So let's take a look at the market, as everything starts and ends there. So now we are finally seeing the much awaited, I wouldn't say anticipated, but the much awaited correction that we had been looking for, that had begrudgingly and stubbornly resisted for some time. So now we're pulling back into the range here, and we're getting the type of signs for sentiment, the hallmarks of a bottom coming soon. We're seeing them. So that's a good sign. Fear is very high. We're starting to see increased volatility and volume in this range here. But there's also a lot of good things happening alongside this. And I believe this is what will set us up for the eventual move to new all-time highs. So again, everybody wants to buy the dip until the dip comes. Remember, the price that we pay through volatility is how we get those good returns in the future. So volatility is the price we pay to be able to achieve higher stock prices down the line. So we have our pullback underway, but there's also some things occurring in the market that really, I think, will portend well over the next couple months. So first and foremost, right, corrections happen, and every time they do, people feel like the first time. Oh, if only we had ever experienced something like this before, right? Well, if we look back not too long ago, we did this in April, right? So just when the fear and the bears and the naysayers are reaching a fever pitch, markets find a way to put in a bottom and move higher. And I believe that you're looking at a similar scenario here. Fear will spike. When fear spikes, markets tend to find their footing. So that's first and foremost. Second thing that we want to look at here is fear index. Okay, some important things to note. Let's move this around a little bit. Okay, whoops, hold on. So when fear reaches extremely high levels, it tends to mark a bottom in stocks, right? Fear peaks and stocks bottom. And if you look at previous spikes in fear and where they traded and where stocks bottom, we are right in that area now. Okay, so this is one of those charts that when it goes up, it usually suggests that the market is going through a bottoming phase. The next thing we want to look at is yields, right? Treasury yields, the 10-year yield. When we look at all the lending facilities in the country, mortgage rates, etc., they base their rates on this. 10-year yield is what tells the Fed what they should do. And if you recall, we drew this back some time ago that we were looking for a double top and a lower high in yields, and the yields were going to start moving lower. Make no mistake, this is bullish for stocks. The initial move lower, the swiftness of it, is what has people concerned, because they're wondering if maybe the Fed is a little late to the party in cutting rates, because the bond market is suggesting that they are. Nonetheless, the Fed is watching this and will get around to catching up with this at some point. So monetary easing is on the way. and liquidity for the market is on the way as well. So we talked about the VIX, we talked about the 10-year, and the last is the dollar, right? We're starting to see that dollar weakness. Same thing we wanted to see when we talked about lower highs this year in the dollar starting to play out as well. So again, weak dollar sounds like a bad thing. We don't want to see too much dollar strength because it tends to be a headwind for multinational corporations trading on U.S. stock markets. So this is another thing. So if you can see now, the stock market from a buyer's perspective, things are starting to line up that say bottoms are close. A bottom is close. Remember, bottoming is a process. It's not always a V-shaped recovery. We see these type of things all the time. So you have, again, dollar pointing lower, you have yields pointing lower, right? Two good things for the stock market, and you have fear hitting what could be a high. A third thing aligning well that we are getting closer. So again, markets like to play tricks on people and make it extremely difficult. We believe what they're doing here, markets are forcing the hands of many people who are not prepared for the dip, who did not foresee the dip, right? Just like they did in April, and then the chase will be on for new highs yet again. So relative strength under the market is approaching the same level in April that marked the buy. And just one aside on NVIDIA, because all everybody talks about is NVIDIA on television and the likes. Okay, folks, when stocks move 3, 4, 500% in a rally, we should expect them to pull back 30 or 40%. It's just par for the course. And if we look at NVIDIA, you know, if only, again, we had ever seen something like this before, right? Well, we have. NVIDIA made a huge ascent coming into the first half of the year, and then it pulled back for 6 weeks, about 30% through the course and into the end of May, then went on another vertical ascent, and guess what we're doing again? So if I'm a betting man, which I'm not, I would say that this resolves itself higher. These are generational opportunities to get involved with companies that are changing the world. And yet people can't see the forest from the trees because stocks have pulled back, right? Oh no, it's only down 40%, right? You'll hear. And, you know, my position on this is very simple. For anybody that missed out on a $3 trillion run, should have no opinion to provide to the public about when the top is going to be. They never knew this technology was coming in the first place. So I digress on that point. But again, folks, the earnings picture has not been bad. We had results from Apple yesterday after the close, which were strong and showing continued growth there. So that's a very big market component. So I think what you have here is really nothing more than some late seasonal malaise, if you will. If we go back last July, same type of situation, and then we were off to the races for some time to come. So we think we go a little bit lower. What exactly might that look like? You know, today's a Friday. Markets are pretty light. You have a down day in the works here. Potentially another down day Monday or Tuesday, looking for a bottom, and we move higher. So hang in there. Things still look good. As far as fear and greed, get rid of this stuff. And we are seeing what you'd want to see. Okay, we're in the fear category. Investors are pretty concerned about this pullback, which is good. You know, again, corrections are the pause, the pullback that refreshes the lifeblood of a bull market. They tend to be violent, and this has all the markings of a classic bull market corrective shakeout. Okay, it's swift, it's fast, it's on high volume, right? And that tends to be capitulatory. So again, much different than the markets of 2022, where we just chopped ourselves lower for 14 to 16 months. Okay, we are in an uptrend. Uptrends have pauses, uptrends have corrections. And if you notice, the higher we've climbed, these corrections have gotten a little bit more fierce and a little bit swifter. So again, the market does not make it easy for folks. For those that have missed their entry, that think that they're going to get some kind of incredible gift to buy the market 30 or 40% lower, it ain't going to happen. So if you have any questions, reach out to us. We're always here to talk to you about anything that's on your mind. Have a great day, great weekend, and we'll see you next week on Heritage Insider Weekly.